welcome back to our show, your show, Let's Talk Stocks. In studio with us this morning is Mr. Douglas Robinson. Of course, he's at GK Capital, big investment company. And of course, Cranston, Ewan is CEO of 138 Student Living. And that's exactly why we're here this morning, because they are having an APO. And we're going to be chatting with them about the company, its performances, and why the APO. Welcome, gentlemen.
Thank you very much.
Thanks for having us.
All right, so talk to me. 138 Student Living, doing an APO. Why?
So many answers for that one. What I would say is a couple of things. First of all, what are they coming to market for?
Yeah.
They are actually raising funds so they can do two big things. One is to focus on growth. They currently have somewhere around 1,400 rooms and want to increase that. And so a part of the fundraising is going to help them do that. The second thing is they're going to do something transformational. They're going to completely change how their capital is structured. And at the end of the day, how I like to explain it is they'd prefer, instead of paying the banks, to pay their shareholders. So they're going to pay down some debt, and what that's going to do is it's going to really change their cost structure, and they're going to, I can't even say begin because they've begun already, but they're going to continue to go towards that path to paying more dividends to its shareholders.
All right, so I want to start at the point where we're talking about increasing capacity. 1,400 rooms.
Yeah.
At UWI Mona?
At UWI Mona, yes.
I didn't know there was so much, man. And you're looking to expand that. Is there the need? People are talking about online learning. There's a big move, everybody, new normal. Can you fill all 1,400 rooms and look possible to expand for your shareholders?
Well, here's what I would say to that. And I know that Cranston really is the man on the ground and knows more than I do. But for me, the proof is in the pudding. Right now, 138 Student Living is at an occupancy, which really means how many people there are versus how many rooms I have, of over 90%. They are quite literally turning students away. And so they're looking to meet the demand that they're seeing that is, exceeding what they have to supply.
Cranston, talk to me about that increased capacity and what it will do for you.
So in terms of capacity, we have a demand right now, which signifies that there's excess capacity for us. Usually our benchmark is, let's say we have demands of 20% of the current room number that we have. We have way more than that right now. So let us understand also is that we don't only house UTech, University of the West Indies students. We also house students from the University of Technology. And the Norman Manley Law School. And the University of Technology is showing strong demand. This year alone, we had in excess of 200 and odd applicants from the University of Technology. So it shows you again that even though they are not on the University of the West Indies campus, we house them and there's a strong demand there. And we have to make our facility available for them. So we have to find ways to grow in order to accommodate them also. So yes, the answer is yes.
I like the argument you had put forward about growing top-line revenue. I think when I looked at the numbers, you just had a fabulous third quarter in June. I think the third quarter would have increased top-line by what, about 12%?
Yes, somewhere there.
But for the year to date, I think it's either profits or top-line, but you had grown about 17%.
Yes.
How can this change impact both top line in terms of new revenue, and certainly your cost structure? If you begin to reshape the capital structure, then certainly you will be adding more to profits.
That's right, because in terms of our cost structure, the more you grow your top line revenue in your existing facility, you're able to make use of cost efficiencies. And I would dare to say that since 2009, the leadership of the organization has been focusing heavily on cost efficiency. And that's one of the ways in which we have been able to grow our profitability. And of course, we expect to continue in that vein. Because in our type of operation, if you don't manage your costs and you get it and it runs away from you, then of course you can be in trouble. So every single day we're on top of our costs. For example, our utilities or water is a very key one, if that goes down the drain, then you're in trouble. So our maintenance team it gives us reading every single day, and so we are able to measure and manage that cost. And so as you grow in your existing facility, you'll make use of economies of scale, because you know, you'll make use of economies of scale in terms of your employment, how much staff you need to employ, and so on. The existing staff can manage some of that capacity.
Of course.
And therefore, what you find is that your cost is controlled while your revenue is growing. So it's an important, it's important for us to understand that type of model, and our cost structure, and how we can manage that and grow.
Talk to me about as you look at, so you're significantly real estate based,
Yes.
And so your balance sheet will be affected over time in terms of as the property revalues or so on.
Yes.
What is that looking like now, and where do you intend to see it in the next couple of years?
Right, very important question I've asked. Yes, our balance sheet will tend to revalue. In fact, every year we are mandated to do an analysis of that financial asset,
Yes.
which is recorded in the books. And so you'll see that number either, well, for the last few years it tends to go down a little bit. And then every 3 years we are required to do a professional valuation.
Okay.
Right? So you will see changes on our balance sheet with that. But as we build out additional facility, you will see that that begins to increase. And so for us it is important that we look for opportunities to grow. Bearing in mind that as per the concession agreement,
Yes.
the property revert to the university at the end of the concession agreement. Okay?
Yes.
But that is several years down the road.
So you have a
Yes.
while yet to go.
Yes,
in
we
terms
have quite
of that.
a while yet to go.
Douglas, talk to me about you did mention changing the capital structure and so on, but why you chose the route of APO?
Yes, and we get that question a lot.
Yes.
People say, you know, if there's a rights issue, why did you choose a rights issue instead of an APO? If it's an APO, why an APO and it's a rights issue?
Absolutely.
So what we really tried to do with this transaction was to say, hey, let's try and get the best of both worlds. Right? Because with a rights issue, you're very much talking to a specific set of people. You're
Yes,
saying,
the
you, my
existing
shareholders, exactly, please provide some capital to the business. With an APO, you're saying, hey, you know, anybody can buy in, just like an IPO, just a secondary offer. So with this one, what we did is we actually did both of those things. So the APO itself is structured, forgetting for the moment that we have the ability to upsize. The APO is structured where the company sells just over 500 million shares. Out of those shares, about 60%, so just over 300 million shares, are reserved for existing shareholders.
Okay.
So we're doing two things. One, we're saying to existing shareholders, thank you for your patience, and we are going to reward you by providing you a specific pool to invest in with a better price, $4.05 in the reserve pool. And we're also saying to the general public, you can apply as well, right? Everybody can apply in this. And the general public pool is about 40% of the offer, and that is at a $4.40 price. So we've tried to really manage both interests.
Would your existing shareholders consider that discount important, especially when you look at the fact that there is likely to be a dilution effect?
There most definitely will be a dilution. With any transaction like this, there's a dilutionary effect. And looking at the numbers, you can see that this is actually a significant dilution. So yes, the discount is very helpful, right? Also for those of us looking from the investment perspective, it also allows you to earn a little higher returns than a higher price. But at the end of the day, how we look at it is one or two things. First of all, the reserve pool is not just for existing shareholders. It's existing shareholders, key stakeholders, as well as the actual team that works with Cranston at 138. And so we thought that that would be a great way to incentivize all parties.